So I want to tell you a little bit about my research agenda over the last few months that I've been working on issues related not so much to the financial crisis, but rather the run-up to the crisis itself. This is joint work with all people at Columbia. Patrick is here at the business school, and Jose is in at the economics department. So what I thought of doing is just give you a little bit of an overview of some stylized facts of things that are interesting about the run-up to the crisis, and I'll show you different plots. But let me just summarize the facts, and then I will show you a little bit of some plots if you're not familiar with some of these things. So the first one is that in the period preceding the crisis, the U.S. financial sector accounted for an increasing fraction of U.S. corporate profits. Okay, there was a lot of the profits in the U.S. Economy that were being generated in the U.S. financial service industry. In addition, there was a very strong growth in compensation in the financial service industry, but not in every single sub-segment of the financial service industry, and I'll show you some evidence about this in a moment. Another thing that it was striking for all of us who have been teaching MBA students for the last 15 years, and Charles, Kent, and I have been teaching for many years, is that finance became a very favorite occupation, not just for MBA students, but also for a lot of undergraduates. So all those people who were going and finding a cure for cancer instead went on working for Lehman, which paid more handsomely than finding a cure for cancer. Okay. In addition, one of the things that we saw, at least in the real estate market, and I hope this is not controversial, is that there was kind of a deterioration of what we refer to as origination incentives. At the beginning, say in 2000, 2001, I'll show you some evidence about this in a moment, the mortgages that we were generating were relatively good. By the end of the cycle, right before the Great Recession, the quality of the mortgages that we were originating was rather low compared to the ones that we were originating at the beginning of the cycle. And in addition, there was a big increase in the leverage of some financial intermediaries who increased not only the size of the balance sheets, but also the leverage that they were taking through a variety of instruments. One last thing that I'm going to mention, perhaps a lot of these things, these kind of 4 or 5 facts, perhaps partially known, but one that we don't talk as much about, even though it's also out there, is what we refer to as the growth of institutional cash pools, and that's the uninformed funds of the original title. So one of the things that we saw over the years preceding the Great Recession was that somehow cash, and I will be more specific about this, was accumulating on the asset side of the balance sheet of particular class of agents in the economy. Okay? I'm interested in developing models that somehow can make sense of all these facts. I'm going to take the first 5 facts to be things that I want to explain. I'm going to take this fact to be something that I'm going to take as exogenously given. And this is going to be the source of variation that I'm interested in. This is what is going to be driving all these changes. So let me show you, just in the interest of time, given that we have, how much time? Like 10 minutes, 8, something like this. So let me just rush a little bit and just show you the plots, which I thought it would be fun. So this actually comes from a very interesting paper by Sultan Posar, who's now the IMF, used to be at the New York Fed. And basically what he does is an accounting exercise. He goes and counts cash in the asset side of the balance sheet of a bunch of institutions, okay? And basically what he includes are things like US corporations, long-term pension funds, long-term mutual funds, securities lenders, and so on and so forth. The red line, I didn't focus just on the red line. I'm sorry that somehow it didn't come out well in the PDF file. On the y-axis, you have the magnitude of these funds. It's literally counting them, and it's in trillions of dollars. And the point that he wants to make is that something funny happened around 2001, 2002, that what would you expect about these funds? Well, they should be growing more or less at the rate as the US economy, more or less. Okay, it should be, following each other closely. But somehow something that happened in the early part of the last decade, in 2001, 2002, is that the growth of the cash on the asset side of these balance sheets accelerated significantly. So as it is well known, US corporations started accumulating cash dramatically. So did securities lenders, so did pension funds, who rebalanced their portfolio away from some things and more into cash, as well as long-term mutual funds. And by the way, this excludes money market mutual funds. Make a mental note of this. I will come back to this topic. The second fact that I was drawing your attention, so that fact, I'm not going to have anything intelligent to say about this. We're still trying to understand why did this happen, okay? For me, it's going to be something exogenous. Another interesting fact is the one that is given by this plot, and actually I don't remember where I took this plot from because it's a very famous plot, okay? I think this comes from a New York Fed paper, and it's been reproduced many times. So essentially what you have on the x-axis is the number of months after a mortgage is granted by a bank that mortgage enters into delinquency, meaning the person who took that mortgage stops making the due payments. On the y-axis, the percentage of mortgages in that vintage that actually are in delinquency. Focus for a moment, for instance, in the year 2000, which is that solid line all the way to the top. That basically means that it took essentially 25 months or 26 months to reach a delinquency ratio of 8-9%, okay? So after 25 months of these mortgages being issued in the year 2000, 8% are in arrears, okay? What is that you see? Well, those numbers start improving. So that basically, look at 2001, which is the red dotted line. Well, essentially that went down, so that basically means that, you know, now, after 25 months, there's a slightly lower number in arrears. Look at 2002. Only 6% after 25 months are in arrears, and so on and so forth, okay? What is interesting, though, is that the best year was 2003. Look at the vintage on 2003, which is the blue one over there. After that, 2004, 2005, 2006, those mortgages are going into delinquency at a much faster rate than the previous vintages. So there's an interesting kind of non-linearity taking place here. Until 2003, things were going well in terms of the quality of these mortgages. But after 2003, the quality starts deteriorating, and remember, prices still are going up in the real estate market in the United States. Another thing that was taking place that was kind of strange in the years leading up to the recession is that people seem to be willing to pay incredibly high prices for all sorts of assets, independent of the credit quality of the underlying securities on those assets, okay? So these are the prices of the ABX tranches, which are essentially CDOs, okay, portfolios of mortgage risk, essentially. And, you know, look at those, you know, in red is the AAA, that's the highest quality. Think about 100 being essentially the par value of that security. So that basically means that people are almost paying par for that security. But look at the BBB minus, okay, in January or in May of, you know, in January of 06 or in September of 06. They're essentially paying the same price for the BBB security as they're paying for the AAA security. Whatever was taking place in financial markets at that time, people seem to be willing to pay very high prices for these two types of securities, even though the credit rating was rather different across these securities. Okay, and of course, once the crisis hits, what you see is this big increase in the spread. All of a sudden, people realize that they were holding BBB securities, and they start dumping them and diverging the way you would expect them. This is the asset, you know, this is the size of the balance sheet of the securities brokers dealers, okay? And as you can see, essentially what we saw in the years leading up to the recession is a very strong growth on the size of the balance sheet, which is this blue surface. In red, you have the leverage, which is essentially defined as the amount of debt they have on the liability side of the balance sheet divided by the book equity. And what you can see is that it went up with the size of the balance sheet as well. So not only the size of the balance sheet is going up, but also the debt is going up relative to the book value of the equity. And what you can see as well is that once the crisis comes, they are able to deliver relatively fast. And why is that? Well, because a lot of that leverage was coming from repo transactions that you're able to unwind relatively quickly once the crisis comes, and they were essentially forced to do so. There you have the share of profits that the US financial sector represents of the economy up to 2006, I believe it is. Okay, 2007, 2008, whatever the numbers are. I don't remember exactly until when we go. I think it's 2009. And this is something that is kind of interesting, and I want to make a connection with something Kent said in his presentation. What is striking about this plot is not only the level, but also the trend. The fact that somehow the share of profits went up, started in the mid-80s. So somehow whatever was going on in the financial service sector has been going on for a long time, and they've been essentially increasing the share they represent of the US corporate profits for the last 35 years, 40, you see the big collapse once the Great Recession comes, but then, we do all these kind of measures, economic policy measures, and the things recuperate. The last plot that I want to show you is essentially compensation in the financial service sector. Now we have data going back to the 1920s. This plot comes from a very interesting paper by Thomas Philippon at the Stern School of Business downtown, and essentially shows the wage normalized by the private sector wage. So I take the median wage of people who are engaged in commercial banking activities divided by the median wage in the US economy at large. Okay, that's the way you should think about this. I do the same thing for insurance, and the census gives you another classification that is called other finance, which essentially includes asset management and broker-dealer activities. Okay, so here you have boring commercial banks, here you have boring insurance companies, and here you have broker-dealers and asset managers. And what you can see is that look, there hasn't been much of a trend, if at all. Finance during the 30s and the 40s, during the years of the Great Depression, went down in terms of relative wages. They were essentially flat for essentially 40 years. That's what is striking. So finance was not a particularly attractive profession relative to other, the median profession in the United States. But again, something happens in the mid-80s, and it happens in one particular segment of the US financial service industry, which is that related to broker-dealer activities and asset management. And one thing, of course, is that all the students that Charles Kent and I have been teaching over the years never told us that they wanted to be an insurance broker. They all told us that they wanted to work, or the finance students, they wanted to go for Lehman, Goldman, Bear Stearns, and so on and so forth. Okay, and it is simply a reflection that whatever was going on, was going on in that particular segment. So one of the things that we argue in our work, and shall I wrap it up, or you haven't take another? You tell me. 2 minutes. So let me just wrap it up. Just giving you a motivation for what we're doing. So our research agenda is essentially trying to understand all these facts. And there's one particular thing that I want to show you that I think is interesting, and that tells you a little bit of. Let me just show you a different plot first, and then I'll go back to finance. Sorry. So what has happened over the last 30 years, that is so striking and so different? Well, it's related to the IT revolution. The fact that now, we have all these phenomenal gadgets, machines, computers, networks, and so on and so forth that allow us to process information in a way that was just simply unthinkable 30 years ago, 40 years ago. Okay. Now, what you see across many sectors of the US economy is heavy investments in this IT technology. Essentially, people buy these computers and these systems in order to manage their inventory, manage their sales, track their customers, their customer needs, and their suppliers, and so on and so forth. There's a lot of things that you guys learn in your classes about this when you take those classes on OR, in time inventory management, and so on and so forth. Here you have essentially investments in IT and value added across the retail sector. So in orange you have investments in IT, and in the continuous black line is essentially the value added, the profits that retail sector is generating. And what you see is that these two lines are negatively correlated, and it's not surprising. You invest in these methods, but that increases competition, lowering prices, and the rents accrue, as they always do in a competitive environment, to the customer, to the consumer. Okay, people compete, all these Walmart and Target, Kmart, Costco, BJ's, all these guys are using these kind of very sophisticated information systems in order to run a very lean operation, but eventually this translates into lower prices and the surplus accrues to the consumer. Okay, this is very good for the economy, it's just not very good for these guys. The shareholders do not appropriate the rents of this. But look, there's one sector of the economy in which exactly the relation is exactly the opposite, and that's finance. In finance, you see big investments in IT and increasing profits as a percentage of GDP. Why is that? Why is it that somehow the same technological revolution that is leading to lower profits in other sectors of the US economy is leading to high profits in the US financial service industry during this period. That's what our research is about, is basically coming up with a theory, and it's essentially a theory that says, look, what has happened over the last 30 years in US financial markets is that all this technology has allowed us to actually process information about risks and transact this information in very opaque markets that we call over-the-counter markets. And these guys essentially capture all the rents associated with that information precisely because these markets are opaque. We interpret the history of the US financial markets over the last 30, 40 years as an effort to protect this information on rents. And even if you were to look, for instance, at the recent innovations in US financial markets associated with Dodd-Frank, what a lot of the industry was fighting was not so much clearing and stuff like that. They couldn't care less about that. They were basically focusing on protecting the transparency of the execution. They wanted as opaque as possible in order to capture rents associated with those transactions. And I'll leave it at that.